As a business owner, have you ever asked the question of why should I care about managing tax risk? Well, there are several reasons why you should care. For one, because your organization's financial health and reputation depends on it. Businesses that do not effectively manage tax risk may run the risk of reputational damage. For example, if a business is perceived as not effectively managing its tax risk, it may raise concerns about the company's overall tax risk management practices and financial stability. And this can erode trust and confidence among investors and stakeholders, which can lead to a negative impact on the company's stock's value and its ability to attract investment. So, to help your business avoid such consequences, it's important to engage in proactive and ethical tax risk management. In this video, we will explain how to analyze tax risks and exposure and how to implement corrective measures. So, stay with us till the end. Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of taxmobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos. Analyzing tax risks and exposure involves a systematic and thorough evaluation of potential tax liabilities, uncertainties, and areas of exposure that could impact an organization's tax position. The key components involved in analyzing tax risks and exposure are identification of potential tax risks and exposure. This entails a comprehensive assessment of the various tax-related risks that could impact the organization's financial position, compliance obligations, and reputation. It involves scrutinizing the company tax positions, transactions, and activities to identify areas of potential risk and exposure which may arise from factors such as changes in tax legislation, complex tax transactions, uncertainties in tax interpretation, or aggressive tax planning approaches. Identifying these risks allows the organization to proactively address vulnerabilities and implement measures to mitigate, manage, or eliminate them. Assessment of transfer pricing implications. This involves a detailed analysis of the intercompany transactions and transfer pricing policies to ensure compliance with Nigerian transfer pricing regulations and international standards. Transfer pricing refers to the pricing of transactions between entities within the same multinational enterprise. And these transactions may include goods, services, intangibles, or financial transactions. The analysis includes evaluating the arm's length nature of intercompany transactions, ensuring the use of appropriate transfer pricing methods, and documenting transfer pricing policies and adjustments. This assessment aims to mitigate the risk associated with transfer pricing adjustments, tax authority challenges, and potential transfer pricing penalties. And it does this by aligning the company's transfer pricing practices with regulatory requirements and industry best practices. Evaluation of tax provisions and contingencies. This involves a detailed review of the company's accounting for tax liabilities, uncertainties, and potential exposures. The process includes assessing the adequacy of tax provisions for current and deferred taxes, as well as identifying potential tax contingencies that could impact the company's financial statement and tax reporting. The evaluation requires an in-depth analysis of the company tax positions, historical tax disputes, ongoing audits or investigations, and changes in tax laws or interpretation that could impact the assessment of tax liabilities. This rigorous evaluating can enhance the accuracy and transparency of a company's financial reporting while addressing potential tax exposures and uncertainties. Now, let's assume you identify some issues during this thorough analysis. What do you do next? That will bring us to the section on implementing corrective measures. This involves developing targeted action plans, establishing robust internal controls, and implementing recommendations to mitigate potential tax exposures. The key components involved in implementing corrective measures are developing action plans to address identified tax issues, This requires a structured approach to tackle potential vulnerabilities, compliance gaps, or identify concerns from the risk assessment. It involves creating detailed and tailored strategies to address specific tax issues, uncertainties, or non-compliance areas. Action plans typically involve setting clear objectives, defining responsibilities, allocating resources, and establishing timelines for implementing corrective measures. These plans help in addressing deficiencies in tax filings, rectifying inaccuracies in tax calculations, or remedying gaps in tax documentation and record keeping. By developing action plans, organizations systematically tackle identified tax issues, enhance compliance, and mitigate potential exposures, thereby serving as roadmaps for rectifying deficiencies, improving tax processes, and strengthening overall tax governance. Establishing internal controls and process improvements. This involves implementing controls, checks, and balances within the organization tax functions to ensure the accurate, reliable, and compliant activities and processes. Internal control safeguards against errors, omissions, or irregularities in tax-related activities through segregation of duties, review procedures, documentation requirements, and approval workflows. Simultaneously, process improvements aim to streamline tax processes, enhance efficiency, and align practices with regulatory requirements and industry best practices. The dual approach helps organizations fortify tax governance, reduce the risk of tax-related errors, and cultivate a culture of compliance and accountability. Implementing recommendations for mitigating tax exposures. This involves taking proactive measures to address, manage, or reduce potential tax risk and uncertainties identified during the tax assessment process. This may include implementing tax planning strategies, restructuring transactions, or engaging in discussions with tax authorities to resolve potential tax disputes or exposures. Recommendations for mitigation are often based on an analysis of the organization's tax position and industry considerations, and they may involve seeking professional advice, adjusting tax planning strategies, or restructuring business operations to optimize tax exposure and optimize tax outcomes. By proactively implementing these recommendations, organizations can optimize their tax positions, align with regulatory requirements, and mitigate uncertainties, fostering tax efficiencies and guarding against potential tax liabilities and disputes. In summary, effective analysis of tax risk and proactively implementing corrective measures provide organizations with a comprehensive framework for navigating the complexities of tax management. The process of risk analysis encompasses systematic identification of potential tax risk, assessing transfer pricing implications, and evaluating tax provisions and contingencies. On the other hand, implementing corrective measures involves developing action plans, establishing internal controls, and implementing recommendations for mitigating tax exposures. This holistic approach optimizes tax positions of the organization and safeguards their financial integrity and reputational standing. However, beyond implementing corrective measures for identified risks, there is a crucial aspect to consider, which is how to prevent such issues from resurfacing. Join us in the next video for detailed explanation, ensuring future compliance and optimization. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.